Hi guys, welcome back. Every time a new cancer drug is discovered or a groundbreaking gene therapy hits the market, these companies are behind the scenes. Quiet, essential, but invisible. They don't create the drugs, but without them, nothing in modern medicine would work. For over a decade, they've outperformed the market, built moats, and generated stable and recurring revenue. Danaher, Thermo Fisher, and Sartorius have ridden the tailwinds of demographic shifts and cutting-edge science for decades. They are the shuffle sellers in the gold rush of global health. But now, their stocks have crashed. But here's the twist. Nothing is actually broken. Aging population, still aging. Biologics, booming. AI drug discovery, just getting started. So why are these companies down? And is now a good opportunity to grab an elite business on sale? In this video, I will analyze the healthcare equipment market in general and compare the financials of all three of these companies in detail to see if they could be a good long-term investment. And if you're new here, my name is Florian. Thank you for joining me today. So we're talking about Danaher, Thermo Fisher, and the German Sartorius AG. And in the last 12 months, these companies didn't have a good run, with Danaher being down by 25% and Thermo Fisher by 22%. Only Sartorius is up by 5%. The last 10 years have looked much better. Here Danaher could produce 250% total returns, Thermo Fisher 260%, and Sartorius could even significantly outperform the market with over 400%. So especially over the long run, these companies could outperform the broader market. And the outperformance becomes even better if we further extend the timeline to, let's say, 20 years, for example. This is because all three of these companies are aligned with not one, but several long-term trends that help them grow. For example, the global population is becoming older and older. By 2050, the number of people above 65 is expected to roughly double compared to today. And of course, just very generally speaking, older people need more medical support. So there is already a strong underlying demographical trend for the whole industry. But there are also more specific trends. For example, the rise of biologics in the upcoming drug pipeline and advanced cell and gene therapies that have grown tenfold in the last 10 years. And AI also has a huge potential to reduce the costs and time for drug discovery and development, which could lead to more personalized medicine. And for all this, highly specialized tools and equipment will be necessary that our three companies today provide. So they are the shuffle salesmen for the whole medical market. I like this very much because I believe that the whole medical market will be a very important and quickly growing one in the next decade. And with these three companies, we can benefit from this growth without deciding for any pharma or biotech company itself. And these companies also bring the advantage that they basically have an oligopoly in this industry. The high technological and regulatory hurdles combined with the high capital requirements provide a significant entry barrier and protect them against other competitors. This shows in the high portion of returning revenue for them. In the case of Danaher and Thermo Fisher, this even makes up over 80% of their revenue, and for Sartorius, it's still at around 75%. This returning revenue is generated with services, consumables, and single-use products for their tools. These are, for example, different reagents and diagnostic kits, sterile filtration membranes, pipettes or sample containers, syringes and cartridges, and even general labware. These single-use products are especially growing quickly for the bioprocessing market, where the CAGR until 2030 is at 15%. The more general life science tool market is growing a bit slower, but even here, the CAGR is still at over 10%. One thing that is helping this market grow and expand is the integration of AI and automation in the research process. And what I find most impressive here is that according to this study from Grandview Research, AI can help to lower the costs and time for the development process of drugs by 90%. And of course, it can also help and speed up many supporting tasks like preparing the regulatory reports, forecasting a new drug price, and writing or reviewing medical papers. So there is currently a lot of potential unlocked that can and probably will lead to cost savings or speeding up the development process. So if these companies all have secular tailwinds and a lot of recurring revenue, why did their stocks crash by so much in the last 3 years? And are they a good investment now? To better understand this, let's first try to understand how exactly these companies earn their money. And let's start with the probably best known of the bunch, Thermo Fisher. They are the largest of these three companies and the one with the most diversified products. They are also focusing a bit more on the scientific aspects of this industry by providing around 15% of their products to academic and government research. They are active worldwide, but over 50% of their revenue is generated in the US. They are split into 4 major business segments. The first one is life science solution with products such as reagents for scientific research or bioproduction. Then we have analytical instruments with a wide range of products for chromatography and spectroscopy. The third segment is their specialty diagnostics segment, where they provide laboratory kits and special diagnostics products for clinical and medical application. And last but not least, we have the laboratory products and biopharma service segment, where they provide the consumables and also development services. Thermo Fisher also has an investor-friendly capital allocation strategy with a focus on paying and increasing their dividends and also share buybacks from time to time. 60 to 75%, so the majority of their capital, is also reserved for M&A activities. And despite the decline in stock price, the company's fundamentals don't look too bad. Yes, we can see that their revenue has stagnated a bit over the last couple of years, which has also affected their net income and EPS. But their free cash flow is currently at the highest level ever. We can also see that the margins did come down a bit since 2020 and 2021, but the long-term trend is still pointing upwards. And here in the detailed cash flow picture, we also see that despite their record level of free cash flow in orange, their operating cash flow in red has declined a bit, and the free cash flow did only grow because they dialed back their capex costs. Their balance sheet is also not half bad, with a net debt to EBITDA ratio of 2.6 and an interest coverage of 4.6 times. So all in all, we have a fundamentally very strong company that did come under a bit of pressure in the last 3 years. But this pressure only came after 2 very good years in 2020 and 2021. So next, let's see how Danaher did. As expected, they are also active in pretty much the same markets as Thermo Fisher, but their revenue is a bit better diversified over these markets. And as I already mentioned, over 80% of their revenues is recurring revenue from their consumables, which makes it pretty predictive. Danaher is generally not so well known as Thermo Fisher because you find products with the name Danaher anywhere. Instead, they operate a bit like the Berkshire Hathaway of the healthcare industry in that they combine many different brands under their roof. These brands are structured in 3 different segments: the biotechnology sector, the life science sector, and the diagnostic sector. Some of their brands are Leica Micro and Leica Biosystems, Radiometer, Molecular Devices, Beckman Coulter, or Sativa. And they are not only better diversified over different markets, they also have the better revenue split over geographical regions. In their case, less than 45% of their revenue is generated in the US. But this was also a problem for them, as the weakness in the Chinese market especially, here defined as high growth market, has put some pressure on their revenues in the last 3 years. Their strategy is highly focused on acquisitions to strengthen the company's position in strategic markets and boost their margins and free cash flow. And to do this effectively and consistently, they have invented the Danaher Business System, or DBS, that they implement in all their brands so that they can focus on growth and still profit from synergy with their other brands. With this, they can keep their overall operations very efficient, which can sometimes be a challenge, especially when a company grows a lot through acquisitions. Unfortunately, this has not prevented their revenue to also decline in the last years, same as Thermo. And this has also put their EBITDA, EPS, and free cash flow under pressure. But we also see that before the recent decline, there was a huge jump in all of these metrics. So over the long run, the company is still growing nicely. The same is true for their margins that are even higher than Thermo Fisher's and also show a long-term uptrend. In contrast to Thermo, Danaher has not dialed back the capex cost though, which is why their free cash flow is down together with the operating cash flow. But their balance sheet looks great, with a net debt to EBITDA ratio of only 2 times and an interest coverage ratio of 18.6 times. That means that they can pay their yearly interest expenses more than 18 times over. So, same as TMO, We also have a nice long-term uptrend, even though their growth was generally negative since the pandemic. I will explain the reasons in just a bit, but first, let's also see if Sartorius shows the same picture. They are a bit more specialized than our other two companies in that they focus more on bioprocess solutions, lab filtration systems, and cell analysis. So they play a big role in the manufacturing of biological drugs. This shows in their business that is split into two sectors: the bioprocess solutions that earns 80% of their revenue and the lab products and services that makes the remaining 20%. This market is still small, but the number of processes, especially in the cell and gene therapy segment, is growing quickly. And Sartorius has a huge range of products here for all stages of the development and also the commercial manufacturing of these processes and products. But even though they are a bit more specialized than our other two companies, their fundamentals look eerily similar to them. Their revenue did also decline from their highs in 2022, but the effect on their net income and EPS was much more severe than in the case of our other two companies. One reason for this is that their margins also came under a bit more pressure, and their profitability and especially their return on invested capital is also a bit below the level of the other two companies. They also have a bit more debt in their books with a net debt to EBITDA ratio of 3.6, which is a little bit above my maximum target value of 3. This is at least partially due to a big acquisition of Polyplus in 2023. But this higher debt ratio has also led to higher financing costs. The result is that the interest coverage ratio has deteriorated to 2.8 times. So, after paying their interest expenses, the company is currently quite restricted when it comes to financial flexibility. Not so much money is left over after paying the debts. So, from a financial perspective, Sartorius seems to be by far the weakest one, while the other two are still pretty strong despite their revenue decline in the last couple of years. And even Sartorius is planning to decrease their debt levels quickly again. But where did this revenue decline even come from? There is actually not one, but several factors to this. First, many laboratories have expanded their capacity significantly during COVID. But the demand for diagnostic solutions has pulled back after the pandemic and has not yet returned to normal levels. Then we have an uncertain situation in the US with trade tariffs and global tensions impacting the investment decisions of many companies. The healthcare sector with Robert Kennedy as minister is especially hit by this. And the higher interest rates also don't help here at all. The business in China has also pulled back noticeably, and China is also trying to become more independent from Western companies, which also has an impact on our three candidates. However, all of these issues, apart from the China business, appear to be easing somewhat at the moment. But all this rather points to a cyclical behavior of the whole industry and not to individual problems of each of these companies. And I think that many of the factors that have contributed to the decline in the last few years are slowly coming to an end. And the current earnings season also seems to confirm that. Both Danaher and Thermo Fisher have just raised the guidance for the current fiscal year in their last quarterly reports. So this could actually be a good time to start an anti-cyclical investment in the sector before the tailwinds kick in again and the stocks become expensive once more. But in order to determine if they are a good investment, we also need to look at the valuation and the forecast for the next 3 years. And while we're at it, let's also directly compare these three companies against each other. And guys, if you like the analysis so far, please subscribe to the channel so you don't miss the next one. I know it's a bit annoying if I ask this, but it really does make a difference, so thank you very much. And now, let's compare our companies directly. In terms of top-line revenue growth, Thermo Fisher and Sartorius could grow with similar rates of around 10 to 12% per year for the last 5 years, while Danaher only had half of this value. Sartorius could even grow their free cash flow the quickest with 13.2%. But as we just saw, this free cash flow growth also came from lower capex costs, the same as with Thermo Fisher. And the underlying operating cash flow did decline for all three companies in the last 3 years. In terms of EPS growth, the three companies are pretty different. While Thermo could grow their EPS the quickest with 13.4%, Danaher's EPS is pretty much on the same level as before the COVID surge, and Sartorius did even decline on a 5-year basis. But just recently, Sartorius also came back to the growth path and could grow it by 12% compared to the last year again. In terms of profitability, Danaher is the strongest in all metrics except return of invested capital, where Thermo Fisher still beats them. Sartorius also has a good top-line margins in gross and EBITDA margin, but their bottom line is quite a bit weaker than the other two companies, with both their free cash flow margins and return of invested capital being well below the other two. This basically shows again that the last acquisitions weighed heavily on Sartorius' cash flow. For me, this is a clear warning sign, and I would monitor this very carefully. Because if this doesn't improve in the next few years, it might indicate a bad capital allocation strategy of the company. It also ties in with their financial health. Here, Danaher has the cleanest balance sheet with the lowest debt and by far the lowest interest coverage ratio. But instead of taking on debt, Danaher did issue new shares for the last acquisition, which has pushed their share dilution to 0.67% per year for the last 5 years. They are still buying back shares on a regular level and if they don't find better uses for their cash. And while this has slightly diluted their shareholders, the level is pretty low. The only company from our 3 today that could lower their share count in the last 5 years is Thermo, that bought back almost 1% of their shares every year for the last 5 years. This is also one of the reasons for the higher EPS growth. All 3 do reward their shareholders with small dividend payments though. Danaher has the highest yield with 0.62%, while Thermo currently has the lowest with 0.36%. But the dividend growth for Thermo is with 14.9% a bit higher than Danaher's 13.7%. All 3 companies have a very low cash flow payout ratio, so there is a lot of room for future growth. And speaking of future growth, the average 1-year price target from analysts for these companies is well above the current price in all cases. The gap for Thermo Fisher is the smallest with only 12% average upside, while Sartorius even has a 1-year price target that is 38% above the price today. But this also aligns with the growth targets for these 3 companies that should be the highest for Sartorius and the lowest for TMO. In terms of valuation, Thermo Fisher and Danaher are pretty on par, well below their 5-year averages, while Sartorius is above their 5-year averages and pretty much above the other 2 in terms of PE ratio. But this is due to the decline in EPS and with the current growth expectation should also be back to normal soon. And because the EPS was stagnating or even declining for Danaher and Sartorius, we can't give a PEG ratio for these 2. I think this reflects their business and chances very nicely. While I think that Danaher and Thermo Fisher are 2 pretty strong and predictable players here, Sartorius' higher growth expectation and price potential also comes with a higher risk. I do like Danaher with their focus on acquisitions and streamlining the businesses most from these 3. They basically took a page out of the playbook from Berkshire Hathaway and applied it to the healthcare sector. But I also think that Thermo Fisher and Danaher are pretty on par and basically interchangeable when it comes to investments. The market and growth outlook is very similar and both have very strong market positions. So regardless of which one of these 2 you choose, I don't think it makes a lot of sense to own them both. And as full disclosure, I am already invested in Danaher, which definitely makes me a bit biased. And also, that's just how I see it. What are your thoughts on the companies and the sector? Drop your thoughts down in the comments. I would love to hear your opinion. And guys, I have just switched my regular ETF savings plan from the S&P 500 that I have used for years now to another pretty unknown ETF. If you would like to know which one it is and why I switched, check out this video right here where I lay out all the details. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys and see you in the next video.